buckle up. I think it's going to be really choppy and volatile. This market could bounce really nicely for a few weeks. It could also drop another 8%, like that in the next few days. I think long-term investors just need to know that the bull market phase, I think, is coming to an end. I think it's about to switch gears. They need to have an exit strategy. If you're with an advisor with a buy and hold, you're going to be riding a hell of a roller coaster ride. It doesn't matter what they say. You've got this 60-40 portfolio in some fancy way that they've manipulated to tell you that you're okay. You've got what everybody else has got, right? But everybody loses together, and that's why they don't get in trouble for letting you watch your life savings vaporize. So those of you watching the video right now who are patient enough and can watch to the end, you'll probably do very well. But those who bailed out,
You're watching Capital Cause, and my name is Danny. Today's guest is Chris Vermeulen. Chris, thanks for coming on again.
Yeah, always a pleasure, Danny. I love talking markets with you.
Yeah, let's go ahead and start talking markets. Let's take it from the top. What is front and center on your radar screen at the moment, Chris? What do you got? What are you most focused on right now?
Well, from kind of a longer term perspective, as an investor, I think I think we're coming to a huge turning point here. The stock market, I think, has lost a lot of upward momentum, very similar to what happened just at the market top of 2022, where we entered a bear market. Except for this time around, things are a whole lot weaker. This time, the Magnificent Seven actually pretty much all are in a downtrend. They look like they've all put in a topping pattern. And that is the muscle for the markets. I mean, that really has dragged the markets up over the last couple of years. And now that muscle is burnt out and shot more or less, I think they're on the verge of a big break to the downside, and that's going to pull the markets down. So that is the big thing. Is I think we're going from a bull market. I think we're actually shifting. I think the market top may be in, and we're starting a bear market that could take several years to recover from for investors who kind of buy and hold. On a short-term standpoint, I think the market is very oversold. It's got a lot of volatility, and I think the markets are ready for some type of bounce. I don't think it's going to be a huge rally and we're hitting new highs. I just think it's going to be a bounce that lasts a couple of weeks, and the market's just trying to find stability right now. This week, we had an exhaustion gap lower on Monday, carried over from Friday's panic selling, and all the signs are there that this market's trying to carve out a bottom right now, a bounce, before it goes, I think, a whole lot lower.
So let's speak in analogs. You mentioned some of the similarities between now and 2022. Is that a proper comparison in your mind, or is there something else that's probably a better fit from a chart pattern perspective? How low do you anticipate this thing going? Because you did say multi-year bear market. So, kind of draw us the lay of the land there.
Yeah. So, I mean, at this point, it looks a lot like 2022 market top. For a lot of reasons, but I'd more so go back to the 2007, 2008 market top. I feel like we're actually at these, it's like a blend between the 2008 and the 2000 market top, in my opinion. We've had tech drag the markets up. Tech this time around actually make money, and they are very profitable. So it's a little different, but the fact that like 7 tech companies have dragged the market higher into this super kind of overextended, overvalued market is kind of a little bit of we got a tech angle here, but we have real estate, I think, topping out. I think economic data is we're seeing unemployment start to rise. I think we've got sales. When we see sales numbers come out, earnings in the next week or two, I think we're going to see things slowing down. We got a lot of noise in this market. The wild card is what Trump is doing when we're seeing like tariffs take place. So a lot of people are buying stuff before the tariffs come in. So it's kind of like creating a surge of buying pressure just before all this stuff comes into play. So that buying surge may kind of throw the economic data, spending and all that stuff out the window for another quarter potentially, just because, everything that's happening with around the world with tariffs and stuff, I think has created a little bit of a shuffle. But I do think we're in this really unique scenario. Every market top is unique, but I think it's a blend between 2000 and 2008. And we're going to see probably a 30 to 50% correction in the SP 500 from the highs. And that usually takes many years to recover from.
And so you talked about the tariffs, and you talked about all this uncertainty effectively. What does uncertainty typically portend to the market? Because I've heard this being said by a number of other analysts as well, is that uncertainty is probably the worst thing that could happen to the market, because buyers just become sellers, and it just becomes a risk-off play. How do you view this?
Yeah, well, when there's uncertainty, you don't know what to do. You don't know what's going on. Typically, people say no, or they walk away, or they, as soon as there's questions and concerns, people don't want to invest. They don't want to do that. So that, I think, is what is starting to happen here. There's a lot of uncertainty going on. We've seen a lot of selling in the stock market. The big drop we've seen over the past week has really sent gold higher. We've seen panic selling on the stock market, and the New York Stock Exchange volume flows. I have an indicator that shows that it just showed massive panic selling. People were just dumping shares. And on the flip side of that, gold shot up through the roof on the same days that there was panic selling in the stock market. And so that's telling us people, when they're uncertain and they don't trust banks, they don't trust the government, they don't trust, the financial system, they move to something outside of that, which is probably why we're seeing gold skyrocket. Physical gold is outside the financial system. We see how Bitcoin have a nice bounce recently. So that's somewhat outside of that system as well, right? So uncertainty means people say no, they move away, they sell, they liquidate. And that's definitely what we've seen over the past month and a half.
So I'm going to play a little devil's advocate here. Why is copper, or otherwise known as Dr. Copper, which is supposedly called the barometer of the economy, why is that getting a bid in this case?
It probably has something to do with, who knows, tariffs or something, but you're right. It has been seen in the past as like the economic barometer. If copper's going up, we should see the economy strengthening. But again, to me, there's a lot of BS going on in terms of tariffs and just inflation and all this stuff that's happening. It creates this uncertainty of certain commodities, and people jump in and say, hey, we got to get this commodity. It's going to be tough to get, or it's going to be expensive later. So it's really hard to gauge when we have new rules and policies coming in place, how it affects. Maybe it's not directly related to copper, but there could be a bunch of things in between that are actually affected. That's going to drag the price of some of these commodities up. I don't like to look at just one particular thing for a barometer of the markets. Copper is generally a good indicator. And copper miners have done really well. They've been moving, higher up and performing well over the past month or so. So we are seeing money move into that space, but I wouldn't look too far into it, because we're in a commodity state right now where typically near the end of a major bull market in stocks, commodity and resource stocks tend to come to life. There's just what happens. And so that's why we're seeing gold, silver, the miners, copper miners have been moving up and outperforming the rest of the sectors. We're just in that space. And it's usually just people getting away from the financial system, moving to more resource based things. It's just the way money seems to flow just before a major market top.
But aren't commodity stocks still stocks at the end of the day? And if we are going to see this, like you said, 50% correction from the highs, won't those commodity stocks also get caught up in the pandemonium, let's call it?
100%. Yeah. I'm not a big fan of holding stocks. So when the market is going down like it is, I'm more so, and I preach this all the time. I'm like, you pick the commodity that's most in favor, which is gold. And gold has been in a steady uptrend. It is slow moving. And the thing is, nobody wants to trade gold because it moves really slow. They want to get into silver. They have to get into miners. They want to make more money. But if you want to make more money and that is your drive, you're going to be caught on the wrong side, because fast moving stuff typically cuts both ways. And usually it cuts down really hard, and people don't have money management, risk management skills in place. And I mentioned this a while ago to somebody else. I'm like, if gold is the most sure, high probability play right now, just physical gold or like a gold ETF, just trade a 2x ETF on it. If you don't like a 1 or 2% move, it doesn't excite you over a course of a couple of days, use a leverage play on something that is like on the winning horse, right? And I actually talked to somebody the other day. They're like, I actually did that. I did the 2x. They've traded it a couple of times. They made like 3-4% a couple times on it, because if they're like, you're right. It's like, it's a very high probability play. And with a little leverage, it actually becomes fun, and I can make a little bit more money versus the miners, which are all over the place, and silver, that pop and drop and can drop 5% in a day, and they're just noisy, right? So you're right. You don't want to hold stocks. And I have not been saying buy gold, silver mining stocks at all. They're going to get hit hard. They're going to probably fall 40, 50, 60, 70% if we go into a recession and a stock market decline. And then they will be a awesome opportunity, but they're going to get hit hard, as you said.
Yeah, I'm looking at the 10-year now, and we've had this drop from the 10-year starting at the beginning of the year or just about at the time of Trump's inauguration to now.
Mm-hmm.
That's pretty much telling me that bonds are coming in favor. And are you starting to see this capital rotation go from stocks to bonds? Is that what's going on here, or is there something else?
Yeah. We've seen that quite a few times now. When there's panic selling in the stock market, we're actually seeing the bond market move higher. And as you just said, the 10-year note, if you look on the daily chart for this year, it's really put in, or actually for the last like 6 months.
You want to pull it up?
Yeah, sure. I could pull that chart up. Take a look at the 10-year, because it's a really powerful chart. This is showing a big tide changing here.
Yeah, because it's probably better for people to see it as opposed to having to imagine it. But yeah,
so you should be able to see my chart here. So what's really interesting is you just pointed out, Danny, how we've seen the 10-year moving down since really the beginning of the year, 2025.
Mm-hmm.
And if we look at this chart pattern, really we have this shoulder, a head, and more or less it's got a shoulder pattern here. And there's a neckline. So this is known as a head and shoulders pattern, a topping pattern. And so more or less a rising trend is a series of higher highs and higher lows. A falling trend is a series of lower highs and lower lows. Mm-hmm. And so this is a topping pattern, and it looks like this wants to have a big break to the downside. And as rates go down, bonds go up. So if I was to just clear this slate and move this over, so this is what the 10-year note looks like. If we go to the bond chart, it's pretty much the flip, the opposite of this. So now we have this inverse shoulder, we got the head, and we got this other shoulder, and yields were going down with a bear flag. Now this is a bull flag, and we've got this neckline across here that we're going to probably see bonds have a really nice move. So I do think this year bonds are going to become a very good play. I think they've put in a bottom. They still might trade sideways for many months, depending on what happens with rates and things like that. But the shift in bonds has really taken place. And when you zoom out on the big picture, going back to the COVID peak, you can see we've gone from a major market top through here to a bear market, and now we're in a basing stage, a stage 1 base.
You're looking for great deals on gold and silver, coins and bars from a company that you can trust, then you've got to check out the good folks over at Pimbex. This year, I've really gotten to know these guys, and all I can say is you're not going to deal with a better group of people. They're a family-owned gold and silver online bullion company offering the essentials and more at industry-leading prices while always providing first-class top-tier service. That's PIMBEX.com. And if you're looking to convert some or all of your retirement account into real gold and silver, give Pimbex a call. They'll help explain the process and get you started on the right path. Your support at Pimbex also helps support the channel. So reach out to Pimbex today. You won't be disappointed. And make sure to tell them Danny sent you.
And a visual way to see that, which I think you and I have shared here before, is to look at these 4 stages of the market. So bonds had the blow off top, but then they broke down. Then it went to a stage 4, a bear market. Now they're in a stage 1, a sideways move. And after that comes a stage 2 bull market. So bonds are about to rise from the ashes. The stock market is putting in a major top. And when we look at the stock market from a weekly chart standpoint, this is the weekly chart of the SP 500. What is happening right through here is exactly the same that happened through here. And we had this poke to a nominal new high. We had a poke to a nominal new high. We've got big selling, and the momentum is shifting. This chart doesn't do much justice. I use a lot of data that actually comes into the trend analysis, and it uses a lot of intermarket relationships. But overall, the market is breaking down, and we are on the verge of starting one of these bearish phases where we go into a bear market. And the equities market fell like 25% in 2022. Right now we're still in this bullish trend. We're about to change. Investors are going to need to jump ship soon and get out, long-term investors. But there's times when you don't want to be holding the markets. And we want to know when there's a bullish environment or bearish environment, and then you need to manage your portfolio accordingly. I think this next bear market phase is going to be a lot worse than people think. I think it'll be a financial crisis, not a 15, 20% pullback. It'll probably be like a 30, 50 plus, and it's going to wipe out a lot of retirements, and it's going to take a long time to come back. That's just what I think and feel. I think the biggest thing, Danny, though, is I always have this bearish outlook because I'm always trying to prepare people. But no matter what the price does, if the market turns around and starts going up, we will stay long as investors, like on this chart. If the market, turns up over the next couple of weeks and goes higher, we could get long as a short-term investor and ride it higher. I don't really care which way the market goes because we don't trade predictions and forecasts. We actually follow price and technicals. And the market has been chattering and jumping around, trying to figure out what to do. And eventually we're going to start a new major bull market, or we're going to start a major bear market. But everything right now is pointing bearish.
Gotcha. Would you say that this bond market rally is kind of like the intermediary stage between capital going from the broad stock market to the bond market to then effectively come through to the, let's call it the resource market, the commodity market? That's kind of like what we saw in 2000 when you saw the initial crash, you saw capital flood into bonds, and then finally into commodities. Is there something similar going on here where we're starting to enter stage two, where money's flowing into bonds, and then eventually it'll flow into commodities, and gold is kind of alluding to that to a degree.
Yeah, the way I see it, like if I was to just draw on the chart up here, ignore the bond chart down below. Actually, I can just get rid of all that. If I was to just draw in here, I feel like the stock market has put in a major high. And I think we're about to put in some bounce and then start to go into a much deeper correction. Like this could be like a 30, 40% correction from the highs. The bond market right now, on the flip side, I believe has gone kind of, should have a different color, but the bond market more or less has gone down. And I believe it's starting to put in a base. And as the stock market starts to go down in the next month, like I think we're gonna have a bounce in the stock market, and then it's going to start to go down. And as it starts to go down, I think right now bonds have that bull flag you and I just looked at. I think as stocks start to sell off, we're going to start to see bonds move up, and they're going to become a defensive play. Now, where gold fits into this is gold right in this phase here. Gold, usually pushes higher and keeps hitting new all-time highs, even as the stock market breaks down for a little bit. But once we hit a certain tipping point, once we actually enter a stage 4 decline, which is usually a little lower, and that means there's everyone in the world is selling, everyone's scared, there's bad news, bad economic data, bankruptcies and all that stuff. Gold will then eventually get pulled down with it. I don't know what I just did there, but
gotcha.
Which
is what happened in 2020, right? During the March 2020 crash. I mean, everything went down, but gold went down. Gold went down at a lesser rate relative to everything else.
Well, gold's a much slower beast, so it doesn't lose as much. It doesn't gain as much either. But that's why it is seen as such a strong play. Like if I flip to the gold chart right now, gold's up and to the right. It has been for a long time. A big move in gold is like 1%, 1.5%. That's a big day for gold. Where silver can move 4, 5, 6% easily. And gold is the global barometer, meaning people who actually have like some significant wealth, they naturally gravitate to gold because it's slower moving. They want to put their money somewhere that is a little more stable, but it's outside the kind of, the financial system and banking and all that stuff. And that's why you don't see like, huge investors piling into miners and silver and all that stuff with their entire portfolio, because those are volatile. They're looking to step aside from volatility, move to something that should hold up some value or hold up better than everything else. And sometimes, as you just mentioned, I think gold will fall with the overall recession and the crash if we have one. And sometimes cash is one of the best positions. Like you don't really want to hold anything if it's going down, and gold will get pulled down temporarily with it. The only way to take advantage of a stage 4 is generally going to be pretty much playing inverse ETFs, which is something that we do. So as the market's plummeting month after month after month, we're holding ETFs that go up in value. And that's really the only way to take advantage of it, because when the markets sink and the tide goes down, almost everything goes down with it.
How much runway do you anticipate gold still has? Because yeah, you make a great point. We've been seeing 1% moves almost daily in the price of gold.
Yeah.
I mean, how much longer can we keep this up?
Well, the next target I have for gold. So gold hit, a couple major targets for us, but the big one was 2750 area. That was our major target. That was based on a pretty much a 20-year cycle, and really the cycle from the 2015 lows to where we are now. So it has hit two major cycle highs, and now we're at this point where everything after this is kind of icing on the cake. The next upside target using the most recent price action is showing about $3,275. That's the next measured move. And at this point, because we've hit our maxed out price targets the style of trading that I use, now we can only measure each incremental leg going higher. I don't just be like, oh, the next stop's $5,500. Like I don't have to come with those projections. You literally have to do like really crazy, super bullish. I don't like to be that way, because as soon as you give huge targets, people throw all logic out the window and they just jump on the trade. And so I try and keep things really boring and dry. I try to protect people, and I show them the big picture and the targets, which we've hit for gold. And now I don't want to fluff it up. I think buying gold up here is actually, you're buying it right just before it's about to go into a bigger correction with the rest of the market. And so I really speak to those who have wealth, who have some logic, and they're not chasing returns. They're like, I want to preserve my portfolio, preserve my lifestyle, and avoid this market crash. If people are chasing huge gains and looking for the shiniest, fastest moving thing, I can't help them, because it's a great way to get hurt. It's not my style. I mean, when you trade fast moving things, you have to trade small position sizes, which means if you have a big account, you need a ton of different positions, which becomes a lot of work, carries more risk. And so I go the opposite. I'm like, how can I have a couple ETF positions, manage our entire portfolio, and ride all these trends through various assets and just rotate? And that's the whole strategy that I use, is this strategy called asset revesting. I wrote a book on it, and it's all about preserving capital, but having oversized returns on average year after year, without having to do a lot of the work and without the downside losses or stress that comes with it.
Yeah. So from, given everything you've said, everything in view, and I'm not asking for like specificity or anything like that, how are you playing the current market from a broad perspective?
Yep.
Like it sounds like, from my kind of hunch, is that you're probably more heavily weighed towards cash in this regard.
Yeah. So for long-term investment capital, like we're still bullish on the market. So long-term investment capital is still long. I do think that's going to change in the next month or two, where we'll move to cash. We'll get out of the market as a passive long-term investor. That is like bull market, bear market cycles. From a short-term standpoint, which is where almost all of my capital is deployed, we are in cash right now. We got out a month or two ago, right near the market highs. We got out as the market started to roll over, and so we are sitting in cash. I wish we were in bonds or in the dollar index that should be moving higher, but they're not. And because they don't meet our criteria of an uptrend, we're in cash, just earning daily interest in monthly dividends until something gives us a better opportunity. And it's pretty boring to be in cash, but it does feel really good to watch the markets fall like 10, 15%. And we totally avoided it. And we're earning interest watching our account push up every day, more or less, while everyone else is losing their shirts. So sometimes nothing is the best play, or cash is the best play. And that's what we're in. And nobody likes it, but I do.
Right. Well, that's probably a telltale sign, right?
Yeah.
Yeah. Well, this one's a personal inquiry. It's just, out of my own curiosity, so to speak. But, I started this channel off as a uranium channel. We covered a lot of uranium stocks back like a couple of years ago. And then we kind of transmuted this entire thing into, gold and, geopolitics and in the broad stock market. So I want to get your take on this downtrend, this bear market in uranium. Is it, where do you think we go from here? Have we bottomed in uranium, or is there still more downside ahead of us?
Yeah, so uranium definitely looks like it's hitting a major. I'm looking at URA ETF. I don't know what you do to track it. That's kind of the only way I follow.
Yeah, pretty much. I use
Uranium.
URNM, but they're pretty much the same thing almost.
Yeah. So using URA, I mean, it's right down at a major support level around that $23 level. It looks oversold. It looks volatile, meaning it's probably trying to find a bottom. I think the stock market is going to bounce. And when the stock market bounces, pretty much everything will bounce with it. So I do think, once this market turns around, I think we could see URA go from $23, which it's at now. I think it could go up to maybe $27, maybe $28. I do think it'll be a kind of a bear market rally. Like percentage wise, that's a huge move for this because it's a fast moving sector. But I think it's a bear market rally or a bear market bounce, meaning it will eventually get sold into. And if and when we go into a financial decline, a big bear market in equities, these things are going to get hit, I think, pretty hard. I think we'll probably see, URA probably back down to like $14 for all we know. Maybe even $12, just where it kind of broke out back in 2020. So I think it could be a pretty big haircut still. Again, if the stock market falls, say, 40%, sectors will probably fall like 60 or 70%. And individual stocks, a lot of them, especially like really low valued ones or speculative ones, will fall like 70 to like 95%. We see that all the time. The VTOL aerospace, stocks, they were like super hot. They're all down like, 95%. And same with gold miners. They crashed 80, 90% during a bear market. Obviously the little speculative ones. And I don't know their uranium space too well, but I feel like there's a lot of little ones and I feel like they're very speculative. So I think there's a lot of downside, which to me is an opportunity. And I talk about this, and I think you and I talked about this a while ago, is after we have a huge financial reset, I am really excited about uranium stocks. I'm hoping we can pick them up for pennies on the dollar, and we'll start a new, 10-year bull market, because I think uranium equals electricity or power. And I think the whole world with AI and the power required, and uranium is clean energy. I think it's going to be huge. I just think timing wise, we need still a financial reset, and then the opportunity is going to be everywhere. It'll be like gold miners, uranium, real estate. You could even dive into high paying dividend stocks that have tons of upside potential plus high dividend. I mean, it's like we're like a kid in a candy store. If you protect your capital and have all of it ready for a new, like after the bear market, you can knock yourself out. Doesn't matter what you buy. It's going to like probably double or triple in price over the next 5-10 years. And you're going to get huge dividends and rewards. So yeah, that's how I see the uranium space.
Yeah, especially if it seems like we were probably a little bit early. Well, not early, because we did see some pretty, multiple 100% gains in uranium and in commodities from 2020 all the way up until 2022. But yeah, I totally see your point that until we see this great, this capital rotation event occur where you see capital go or kind of reallocate from the broad market over to the commodities market, it's not go time until then. We probably only got an appetite of what's to come when it comes to uranium commodities. So
so like just to touch on that real quick, like I think gold and gold and silver miners, they're kind of the first to bottom and rally like after a bear market, and I have a feeling uranium stocks will do the same. I think they're going to be like some of the earliest sectors to come to life with some of the most upside potential. So I really like it, and I do think they could be opportunities before typical stock markets sectors. Because they're commodity based. We do tend to see commodity stuff do very well early. Like they rally before the rest of the stock market does. So it'll definitely be exciting. And I think they might do that same thing as gold and silver miners.
Yeah. So here's a chart, and I want to share it with you. So this is the Thomson Reuters CRB divided by the S&P. So a little ratio analysis here. I mean, we are all the way down here in the dirt when it comes to that ratio. So that goes to show you the relative imbalance as to where capital is currently at the moment between commodities and the S&P. And it seems like you have a little bit of a breakout going on here. I mean, what do you think of this little chart pattern here? I mean, is this the beginning of a capital rotation event?
I would probably draw the lines a little differently. So you've got that line. If you connect the top left of that line to actually the top of a candle, not a candle wick, but a candle, and then bring the line up to further down to connect across the top there. I would say that is more, I don't like long candle wicks because it's usually an event in a blow off phase. It's not true body. Like I like the body range of candles. So that is how I would look at it. Like, it might pierce through this line and create some noise and a false breakout, just like that candle, the first big candle there. But overall, the body range to me is the most important because that's where it opened and closed and spent its time. The wicks are the whipsaw, the shake and bake stuff. So that's how I would actually see it, which totally changes the view of that chart from your perspective.
So then that puts us in like a critical moment, right? So it's either it's a make or break moment. Do we break?
But you're right. Commodities are like the most undervalued like they've ever been in terms of like the stock market. And I do think there's going to probably be more pain, but they're going to get driven down even more. But that creates more of an opportunity for all this down the road. So the key is like try not to lose your shirt in the process and have gunpowder dry and ready for after this event when these things like the commodity resource space is going to feel so affordable and so fairly valued and have so much upside potential. I mean, good stocks get beat up. Like look at Tesla, it's down like 50% and it's still way overvalued in terms of where it stands with other companies. From certain people's perspective, it can still get cut in half and still be, have a normal PE ratio. So I never try to look at things like it looks oversold and it seems fair value. I really just follow the price. I'm like, when the price actually turns around and is pointing up, I mean, I'll be interested in looking at it. But if it's going down, I really just, I don't want to be part of it, or I want to make sure I'm profiting from falling pricing.
Right. Let's get your view on the oil chart. What do you make of let's go ahead and adjust the the lines here. So we're right back. So we are at another critical point here when it comes to the oil chart.
Yeah.
And of course, the oil chart is pretty much correlated with the commodity chart, right? I mean, so, oops. Yeah. So what do you, where do you think we go with oil? Considering, I mean, I'm assuming since we're seeing market weakness, that there's probably more downward pressure on the price of oil versus otherwise.
Yeah, the whole commodity and oil space. I mean, I know there's a lot of manipulation going on there. There's all kinds of new rules and stuff going on with oil and importing and blocking it and exporting all that stuff in Canada and who knows. So there's going to be some noise from all the BS that's out there. But overall, to me, I'm very bearish on oil. I think it's just hanging on to a thread. Like once it breaks clearly below $66 or $65 a barrel, I mean, it's plummeting. I could see it back down at like $45 a barrel over within the next year or less. And I think that's going to send energy stocks tumbling, which there's huge divergence. You look at the oil chart, it's been going down for the past couple of years. Energy stocks have been going up and trading near all-time highs. So there's this massive divergence. I think war and uncertainty has got people piling into dividends, energy stocks, because they're worried and they think energy is going to spike with all this stuff going on. And also people move into the energy stocks because they're high dividend and there's some big brand names in there where advisors are always like, yeah, just buy these big, strong companies. And so they're getting, I think, lifted by people moving in, trying to get yield and dividend. But the problem is I think the energy stocks are going to get hit like easy 30% to the downside during this market correction, if not way more than that, double that. And oil is going to be kind of, I think, the leading barometer. I think we're going to see oil break and close below 65, a fairly strong close below it. And it's probably going to be tied with some economic data. Something's going to come out that, whoa, the economy is actually starting to slow. And then once oil breaks down, I think all the investors in energy stocks are going to be like, wait a minute, maybe I should get out of my energy stocks. And then they're going to tumble afterwards. That's how I kind of see that space going. And I mean, the economic data side of things is really difficult to gauge because everybody's changing the calculations and what's in inflation and not inflation and all the numbers. Everything gets really thrown out of whack. So I don't really care too much about economic data. I'll look at the charts for an overall bias is unemployment rising or layoffs rising, all that stuff. But yeah, energy, oil I think is going to be one of the better barometers of the economy, the global economy.
Yeah, it's just like you said here. So this is XLE, the energy sector ETF divided by oil, and it's been in a for the last couple of years, it's been in a fairly strong uptrend, right?
Yeah. Yeah.
So,
Mhm.
yeah. Well, cool. Anything else you want to talk about, Chris? That's pretty much all I had lined up for us today. Any big data points or topics you want to bring
No,
up before we
I
wrap
think
up?
I think we touched on it. I think short-term traders just buckle up. I think it's going to be really choppy and volatile. This market could bounce really nicely for a few weeks. It could also drop another 8%, like
Hmm.
that in the next few days. I think long-term investors just need to know that the bull market phase, I think, is coming to an end. I think it's about to switch gears. They need to have an exit strategy. If you're with an advisor with a buy and hold, you're going to be riding a hell of a roller coaster ride. It doesn't matter what they say. You've got this 60-40 portfolio in some fancy way that they've manipulated to tell you that you're okay. You've got what everybody else has got, right? But everybody loses together, and that's why they don't get in trouble for letting
Yeah.
you
Misery loves
watch your
company.
life savings vaporize. But no, that's about it. I think we covered it all, Danny.
Excellent. Chris, where can people find you if they want to hear and see more?
Yeah, the best spot is to go to on YouTube, just The Technical Traders, or type in my name. You should see me there. And I share videos. I draw on the charts almost daily. And also my website, thetechnicaltraders.com. And there's a free newsletter. You can follow my analysis and get some odd trade opportunities. We traded Bitcoin for about a 40% gain. I think there's an inverse energy trade coming up, which should be about a 30 to 60% gain. But we have to let that one mature. It's still probably another month or 3 out.
Hmm.
But I share those occasional trades that I put on with my own portfolio as a speculative kind of fun plays.
Yeah, I mean, I've got to take my hat off to you because, last time I had you on, I believe it was a few months ago, and it's been playing out just like you said. I think, maybe I had you on like 2 months ago or 3 months ago. Now it's pretty much the top in the NASDAQ and the S&P. And you forecasted everything that we've seen so far. So kudos
Right
there,
on. Yeah.
Chris. All right.
I'd like, yeah, appreciate it. It's not about forecasting though. I mean, I'm wrong more times probably than I'm right, but it's about where you're positioning your money, right? Like I can be wrong, but we're actually still in the right trade. It's like, my analysis is to try to prepare people mentally to be like something bad is coming or a new bull market is coming. We just need to be ready to change gears. People don't like just to be caught off guard and be like, oh my God, we got to change trades. I didn't know this was even coming. I try to prepare people. And a major bull market top takes forever to unfold, and the governments and systems kick the can down the road and drag it out. But yeah, it's the markets are moving pretty much like they should, in my opinion. It just takes always a little longer than you anticipate.
Yeah, and especially when you couple that with the ADHD driven, society that we live in today, where instant gratification is the norm, you can really, if you are patient, that is in effect an edge that you can arbitrage psychologically to get ahead of the masses.
Yeah. So those of you watching the video right now who are patient enough and can watch to the end, you'll probably do very well. But those who bailed out, they're the
Right.
short-term traders who are suffering.
Yeah. All right, Chris. Well, thank you so much for coming on. It's always a pleasure. Guys, if you enjoyed this podcast, be sure to give us a like and subscribe to the channel so you don't miss another episode like this. Also, check us out on Substack. It's capitalcosm.substack.com, where you can get early access and ad-free versions of all of my videos, as well as uncensored versions for the ones that warrant it. And then if you enjoyed what Chris had to say and you agreed with his take, right, go Chris, go in the comments section. If you disagreed with anything, let us know as well. We do read the comments. So really interested in getting your takes here, guys, whether you don't have the answers, you may have the answers, or maybe you do have the answers. Drop them down below. You might inspire something in me, just based off of, your insights. So always interested in hearing what you have to say, guys. Thank you so much for watching, and I will catch you in the next episode. Bye, y'all.